What I'd like to do is to give you a guide as to how the Enterprise Investment Scheme, EIS, works, to help you reduce your tax liability, or as a company to help you raise finance. This is not a tax training video. What we're trying to do is just to give you an outline of how the relief works, so it will help you. Now, the aim of EIS is to give people tax relief when they invest in new shares in a growing small business. So if you're looking to raise finance, then you need to understand how the reliefs work so that you can make your proposition attractive to investors. Now, it's not at all uncommon to misunderstand EIS because it's actually three separate tax reliefs all rolled into one. Now, when we first started doing EIS, which was back in the 1990s, a lot of it was motivated by the wish to defer capital gains tax, so that if you invest in a new company, and you can own the whole of the shares in that company, but if you invest in that company and you have previously had a capital gain, whether it was rising on sale of shares or maybe a buy-to-let, then you can defer that capital gain until you dispose of the shares in the new company. So for some clients, if they've held them for 3 years and then they leave the UK, actually they have permanently deferred the capital gain. Now, one thing to remember is that you can actually claim the capital gains tax relief however much of the company you own. So we've used it on quite a number of occasions for clients who are setting up their own company, often a consultancy company, and they want to acquire commercial property to use for their business, and the EIS scheme is an extremely attractive way of funding that and getting significant tax relief if you've got capital gains. Now, the second element of the relief is the income tax relief, which you can claim in addition to claiming the capital gains holdover. It's an income tax relief, and when you invest in the shares in the company, you get back as income tax relief 20% of the amount that you invest. Now, what's very important to notice is that for this second element, the income tax element, the requirement on share ownership is different. You must own less than 30% of the shares, otherwise you will not qualify. Now, you can't get the income tax relief if you were either previously or subsequently connected with the company. So normally that excludes employees and directors, and they can't claim the relief. But there is a special exemption that for people who join in a business venture as angel investors, then provided they only become a director in consequence of having made their investment, then they'll still be able to get the income tax relief. So the third element of the relief, which only applies if you qualified for the income tax relief, is that any capital gain you make on the increase in value of those shares is going to be tax-free. So if you were able to have claimed the capital gains holdover relief as well as the income tax relief, then when you come to sell your shares in the company, all you will pay tax on is the original amount of capital gain which you held over by making the investment. So even if you made £1 million of profit, you would still pay no tax on that profit. Now, a few notes of caution with the relief. The first is that you can only claim the relief if the company has been registered with HMRC and that you have the right paperwork in place. Now, the paperwork can only be issued after the investment, but to give you advanced notice that you are going to be able to qualify, there is a clearance procedure. So you can apply to the revenue and they will tell you whether it appears that the company is going to qualify. Secondly, you have to be aware that if you break the terms of the EIS within 3 years, then not only will you have to pay the income tax relief back, but you will also have to pay interest on the tax from the date when it should have originally been paid. And that can occasionally catch out people if they make a small investment in a company and that company is then taken over by a public company. Then at the time of the takeover they will lose their EIS status, even though their own shares may not be bought back by the company that's made the acquisition until a later date, and that can be quite expensive. So EIS is a great scheme. It doesn't cost a lot of money to set up, usually under £2,000, And so if you're serious about raising investments from angel investors, then we would recommend that it's something you should have in place. We've done at least 30 such EIS companies, and if you'd like to give us a call, we'd be delighted to help.